A missile arcs across the Iranian sky, slams into the outskirts of Tel Aviv, and sends Pentagon war rooms into high alert. Half a world away, a Chinese cargo vessel docks in Mumbai, unloading Russian oil paid for in rupees and yuan. Not a single dollar involved. This wasn't the plan. This wasn't the order. But it's quickly becoming the new operating system of the world. Ukraine was supposed to be NATO's defining stand, hundreds of billions in weapons, surveillance, and training. The expectation, repeated across Western think tanks, was clear. Russia would be isolated, its economy suffocated, its military broken. Instead, according to Bloomberg, Russia's GDP is projected to outpace every G7 nation in 2025. Well, continues to move. The ruble, bolstered by trade with China and India, has stabilized. On the battlefield, Russia now holds more territory than it did before the invasion. Iran's fate was also written in advance. Western sanctions, targeted assassinations, and blockades would keep the regime contained. But in June, after Israel executed a precision strike that eliminated senior Iranian officials, Tehran responded within hours. The Wall Street Journal confirmed over 300 drones and missiles were launched. Most were intercepted, but a dozen got through, hitting military and intelligence targets. The cost imbalance was staggering. A single $800,000 Iranian missile forced the launch of two $3 million Israeli interceptors. The math is unsustainable. Then came China, not through warfare, but through dependence. According to the Financial Times, China refines over 90% of the world's gallium, germanium, and rare earths, minerals critical for radar, satellites, missile guidance, and electric vehicles. In 2023, Beijing began restricting exports. By early 2024, Western defense manufacturers were quietly flagging severe supply bottlenecks. The paradox, the very country the West aims to contain is supplying the components needed to do so. Liu Yaqchong, deputy director of China's Ministry of Industry and Information Technology, summed it up bluntly. We no longer sell components. We sell leverage. In July 2024, a Pentagon munitions report confirmed something chilling. Production of several guided weapons had stalled, not because of funding, but due to shortages of refined antimony and tungsten, both largely sourced from China. NATO's rearmament strategy wasn't undermined by political will, but by periodic table logistics. Camille Gran, former NATO procurement chief, put plainly, in war planning, we assumed ammunition shortages, not element shortages. The EU pledged €500 billion to defense modernization. But as Germany's Rheinmetall CEO told Reuters, we can't fulfill contracts without inputs, and those inputs come from China. For years, BRICS was treated more as an acronym than an alliance. That changed. In late 2023, Brazil, Russia, India, China, and South Africa expanded the bloc, inviting Egypt, Ethiopia, Iran, Argentina, and the UAE. Collectively, they now control 44% of global oil reserves and over half of the world's food production capacity. At the 2023 BRICS Plus Summit, South African President Cyril Ramaphosa said, "This is no longer a club of ambition. It's a platform of supply." By Q2 2025, the World Bank reported that BRICS Plus economies were outpacing the G7 in both GDP growth and trade volume. This isn't hypothetical. It's happening. In April, Brazil and China settled 85% of their trade in yuan and reais. India buys Russian oil and rupees. The SWIFT network, long the West's monopoly on global finance, is facing mounting pressure from China's CIPS and Russia's SPFS alternatives. According to the Bank for International Settlements, global dollar reserves have fallen to 57%, a 30-year low. The dollar isn't disappearing. It's diluting. Roberto Campos Neto, Brazil's central bank president, told Folha de São Paulo, "For the first time, reserve diversification isn't theoretical. It's transactional. This wasn't supposed to happen. Not like this." The U.S. built the global financial infrastructure, Bretton Woods, SWIFT, the IMF. Its power came from ubiquity. But ubiquity only works if there's no alternative. Now there is. And even multinational corporations are adjusting. Apple has begun accepting yuan payments for components in Shenzhen. Tesla has partnered with BRICS-backed lithium suppliers in Bolivia and Zimbabwe. According to the Wall Street Journal, nearly 60% of Fortune 500 companies now conduct some transactions outside the dollar. Decoupling may be U.S. policy, But recoupling with BRICS is the global reality. An Indian trade official told a Hindu, "We don't decouple, we dual track." That's how modern empires survive. India plays both sides with surgical precision, participating in quad naval drills with the U.S., while ramping up Russian oil imports and investing in Iran's Chabahar port, a move sanctioned by Washington. India's Ministry of Commerce reported a 220% increase in trade with Russia in 2024. Strategic ambiguity isn't a diplomatic failure, it's a calculated strength. Africa's shift is quieter, but equally significant. Nigeria secured a $15 billion infrastructure package from China's Exim Bank. Egypt, now a BRICS member, shifted 20% of its defense procurement to joint ventures with Russia and China. Kenya has transitioned its military GPS targeting systems from US-based platforms to China's Beidou network. The West speaks of shared values. BRICS offers roads, chips, and energy, no strings attached. Kenya's infrastructure minister, Kipchumba Murkomen, put it bluntly to Business Daily Africa. "We're not rejecting the West. We're just rejecting delays." In Europe, the shift is no longer theoretical. France signed LNG contracts with Qatar, settled in yuan. Hungary welcomed Chinese investment for a new battery megafactory. According to Eurostat, China overtook the U.S. as Europe's top trading partner in 2024. On paper, the EU criticizes Beijing for unfair practices. In practice, it signs new deals every quarter. Hungarian Prime Minister Viktor Orban told Mandar Weekly, "We are Europeans, but we'd be fools to ignore who builds our batteries." Semiconductors were supposed to be the pressure point. The U.S. imposed sweeping export bans targeting Huawei, SMIC, and China's AI chip ecosystem. But the result wasn't containment, it was adaptation. Digitimes reports that Jinding Technologies' substrate division surged 30% year-over-year. Their strategy? China for China. Build locally. Sell locally. Sanction-proof the supply chain. Sun Ji, CTO of Jinding, told Kin Global, "U.S. sanctions forced us to localize 5 years faster than planned. Thank you." Meanwhile, NVIDIA's H20 chip was blocked from China, but demand for domestic substitutes spiked. CEO Jensen Huang called a ban a strategic backfire. Taiwan's Unimicron, once a dominant substrate supplier, reported declining utilization at its China-based plants. Chinese rivals stepped in and are now on track to surpass Taiwanese firms in volume by 2026. The West assumed China's tech rise depended on foreign IP, but the sanctions sparked a domestic tech rally. China didn't pause. It accelerated. Currency fragmentation is no longer a forecast, it's a fact. The Shanghai Energy Exchange now settles oil contracts in yuan. Russian firms are testing gold-backed digital rubles. The UAE and India finalized an oil deal settled in dirhams and rupees. According to Bloomberg, by May 2025, 22% of global oil contracts were settled in non-dollar currencies, up from just 6% 3 years ago. A UAE energy official told Al Arabiya, "If our barrels go east, why should our billing go west?" Even soft power is shifting. According to QS World Rankings, Tsinghua and Peking University are now among the global top 20. U.S. universities, once dominant, are losing ground, citing rising tuition and visa backlogs. Students from Latin America, Africa, and Southeast Asia are increasingly choosing BRICS-aligned institutions. This isn't about ideology. It's about access and relevance. Ben Soter, editor at QS, told Times Higher Ed, "The demand curve is shifting. Students chase relevance, not flags." And now the final irony. The very system designed by the West, free markets, global trade, technology diffusion, has become the engine of BRICS' rise. The dollar-based system incentivized scale. Now scale lives in BRICS economies. Export controls meant to choke rivals ended up birthing domestic ecosystems. Michael Pettis, economist at Peking University, explained, "You can't contain a country by forcing it to grow its own economy. The compliance that once kept nations in line, it's now optional. You don't control the system when you're the only one following the rules." Iran fires a missile. China clears an oil deal in yuan. Russia ships fertilizer to Brazil. No SWIFT needed. Each action seems isolated. Together, they form a pattern. What we're seeing is not defiance, it's departure. Not collapse, but replacement. The old order wasn't overthrown. It was outgrown. This isn't a BRICS victory lap. These countries face deep internal problems: poverty, censorship, corruption, inequality. But they no longer wait for Western permission to act. In a world with alternatives, monopoly isn't possible. The West hasn't lost control, but control is no longer assumed. As H.R. McMaster, former U.S. National Security Advisor, said at a size panel in 2025, influence without exclusivity is the new frontier of power. So we end where we began. A missile lands in Tel Aviv. A cargo ship unloads in Mumbai. A transaction clears in Shanghai. None required Washington's approval. None were reversed. That's not defiance. That's the new normal. If you found this breakdown valuable, don't forget to like and subscribe.